Hello students, today we discuss about MCQ of banking and financial institutions. It must cover Exim Bank, e-banking, Basel forms and financial institutions like IDBI, IFCI, and Treasury Bill, RBI, NABARD, LIC. So let's go. First question. Exim Bank was set up in option A 1980, option B 1982, option C 1984, option D 1986. Export-Import Bank of India is called Exim Bank. It is a public sector financial institution. It was set up in 1982, headquartered in Mumbai. It is established for financing, facilitating and promoting foreign trade in India. It was previously a branch of IDBI, but as the foreign trade sector grew, it was made into an independent body. So the ultimate aim is to promote foreign trade activities in the country. So here option B is the correct answer. Exim Bank was set up in 1982. So option B is the correct answer. Next question. The LIC was established in option A 1920, option B 1926, option C 1956, option D 2001. LIC, that is Life Insurance Corporation of India. It was created in 1956. LIC is one of the leading insurance firm of India. It is the most trusted company, enjoying more than 60 years of trust and confidence of people. It is known as the pension provider of the country. So LIC was created in 1956. The primary objective of LIC is to provide life insurance policies to all the section of the society. So here option C is the correct answer. LIC was established in option C, 1956. Next question. RWA with regard to capital adequacy stands for which one of the following? Option A, risk withdrawal adjustment. Option B, risk weighted adjustment. Option C, risk weighted asset. Option D, risk free weighted asset. RWA stands for risk weighted assets. Risk weighted assets are used to determine the minimum amount of capital that must be held by bank and other financial institutions in order to reduce the risk insolvency. So the capital requirement is based on a risk assessment for each type of bank asset. The main aim of the risk weighted assets is to determine the minimum amount of capital, then in order to reduce the risk insolvency. So here answer option C is the correct answer. RWA stands for risk weighted assets. Next question. Basel II norms are associated with which of the following banking industry? Option A, risk management. Option B, manpower planning. Option C, corporate governance. Option D, none of the above. Basel norms. Basel norms basically standard norms for regulation of banking sector by the central bank. These norms are drafted by the Basel Committee on Banking Supervision, BCBS, under the Bank for International Settlement, BIS. BIS was developed in 1930 in Switzerland. The basic objective of Basel norm is to promote coordination among the central bank of member countries. So the ultimate objective is to risk management. How much amount the bank should keep as capital in order to deal with those kind of risk, and how much risk should allocate to different kind of assets. We are called as RWA, risk weighted asset. So what proportion of risk would be assigned to different classes of assets? It is called Basel norms. Basel norms are three forms: Basel I, Basel II and Basel III. Looking at Basel I, II and Basel III, both the period of time the Basel norms were revised. More additions were needed. So firstly it was introduced Basel I, where it was fixed that minimum standard of capital that should be kept by commercial bank, okay, would be 8% of risk-weighted assets. And in Basel II norms also it was 8% only. But in Basel III it was increased 9%. Then CAR, Capital Adequacy Ratio. This term is very important related to basic Basel norms. Okay, CAR, CAR, also known as Capital to Risk Weighted Asset Ratio. Okay, equation CAR equal to tier 1 plus tier 2 divided by risk weighted assets. Here tier 1 which means it's a core capital or paid up capital. Then tier 2 that is a subordinate capital. So total capital divided by risk weighted assets. This ratio was introduced with the objective to protect the bank depositors by promoting stability and efficiency in the banking system across the world. Okay, so CAR is very important term related to Basel norms. Basel I. It came in effect in the year 1988. It focused a majority on credit risk, the risk of default. So whenever the bank or financial institutions is provided loans, always a risk associated, whether the loan would be repaid or not. The EMI which are set, will that timely paid or the borrower may default of that? Okay, this was credit risk. Then minimum capital requirement, okay, 8%. According to Basel I, it was 8%. So 8% of risk-weighted asset should be maintained by banks and financial institutions in order to deal with the risk related. Okay. The main objective of Basel I is to strengthen the soundness and stability of banking system and to have high degree of consistency across the banks. India adopted Basel I guidelines in 1999. Next one, Basel II. It is a revision and expansion of Basel I that was published in 2004. It focused on credit risk, market risk and operational risk. Okay, in Basel I only related to credit risk. But Basel II, they deal not only credit risk but also market and operational risk as well. So their risk related to operational banking, there should be some error or the work would be not done properly. Okay, or the process is not efficient. So that will lead to the operational risk. Then also there is also involvement in market risk. So what is the interest rate, what is the fluctuations in the market, how the economic situation is, recession or something. So these risks taken into consideration. So Basel II said that we need not only credit risk but also market risk and operational risk. Basel II provided for better risk management practices and advised a bank on using internal systems for assessment of risk. There are here three pillars in Basel II. Pillar 1, minimum capital requirement. It is same as Basel I, that is 8% of risk-weighted assets. Then another thing, supervisory review process. Supervisory review to keep control on the operational activities of business. Then pillar 3, market discipline. We need to analyze market as well as discipline so that can get a clear picture about risk associated. Okay, so here very important point, Basel II, that is to provide better risk management practices. Next one, Basel III. Basel III is a comprehensive set of reform measures developed by the Basel Committee on Banking Supervision to strengthen the regulation, supervision and risk management of the banking sector. To strengthen the regulation, supervision and risk management of the banking sector. Then it increases 9% capital requirement on continuous basis. So increases the risk involved in banking business because the competitiveness increases and the new technology in innovation, growing advancement in the particular sector. So along with the risk was increasing. The next point is check credit rating. It ensures before providing loans to the banks, check the institution credit rating. So get an idea about credit period of particular institution, what has been their past behavior, was it good? The amount of loan to be given basis of it decided. Okay. Next point, NPA management. NPA management give loan assets which are given classified in a regular basis. Standard assets, substandard assets, doubtful asset, then loss asset. Then standard assets. First one, standard asset. Standard assets are performing assets. If the loan which the borrower is making timely payment and is seeing to be the good position, that would be categorized as standard asset. Then, if they default in payment in a particular time period, the time period say that less than or equal 12 months, so it would be categorized as a substandard asset. Then, if the assets are default in payment for a period more than 12 months, are called a doubtful asset. Then loss assets which cannot be recovered, it's called a loss asset. These assets can be identified by the central bank or by the auditors. Okay. So here option A is the correct answer. Basel II norms are associated risk management practices. Next question, which of the following are the forms of e-banking? Okay, select the correct code. Option A, internet banking, B, telephone banking, C, electronic check conversion, D, electronic bill payment, E, direct fund transfer through RTGS. Okay, then given certain code. Number 1 ACD, number 2 BCD, number 3 ABCD, number 4 ABCDE. Okay, what is e-banking? E-banking means conduct of banking operation through electronic means of devices such as internet banking, telebanking, ATM, electronic fund transfer, credit card, debit card, smart card, electronic check, then electronic bill payment system. Okay, so it is a process of delivering of banking services through electronic devices. Okay, here options are internet banking is correct, telephone banking, electronic check conversion, electronic bill payment, then direct fund transfer through RTGS. RTGS stands for real-time gross settlement. Okay, real-time gross settlement is a fund transfer mechanism where transfer of money take place from one bank to another. This is the fastest possible money transfer system through the banking channel. Okay, so this is also correct. So here option 4 is the correct answer. All the points related to e-banking. Okay, option 4 is the correct answer. Next question, which one of the following financial institutions coordinate the functions and operations of all the financial institutions into a single integrated financial structure so that each may contribute to the growth of the economy? Option A, IFCI, option B, UTI, option C, SIDBI, option D, IDBI. IFCI, Industrial Finance Corporation of India. It was set up in 1948. The primary goal of IFCI is to provide medium to long-term financial assistance to the manufacturing, services and infrastructure sectors. Then UTI, Unit Trust of India. Okay, it is a statutory public sector investment institution which was set up in 1964. Okay, the basic purpose of setting up UTI is to provide opportunity for small savers to invest. Then SIDBI, Small Industries Development Bank of India. Okay, it is a statutory body established in 1990 as principal development financial institution for promotion, financing and development of micro, small and medium enterprises. Okay, MSME.
Then IDBI, Industrial Development Bank of India. It was constituted in 1964. The basic objective of this constitution is to provide direct and indirect finance to industries. And an important function, to coordinate the activities of other institutions providing term finance to industry and to act as an apex institution. This was asking in the question, to coordinate the activities. So answer option D is the correct answer. Which one of the following financial institutions coordinate the functions and operations of all financial institutions? So option D is the correct answer. Next question. Which of the following organizations in India is mainly working to meet the credit needs of all type of agricultural and rural development activities? Option A UTI, option B NABARD, option C IDBI, option D ICAR. UTI stands for Unit Trust of India. Then NABARD, National Bank for Agricultural and Rural Development. Then IDBI, Industrial Development Bank of India. Then ICAR, Indian Council of Agricultural Research. So here option B is the correct answer, NABARD. National Bank for Agricultural and Rural Development. It was set up in 1982. Main functions to provide refinance assistance for agricultural, promoting rural development activities, and also it monitors the flow of ground level rural credit. Then it undertakes research and development in agricultural and rural industries. And also it undertakes an inspection of regional rural banks and cooperative banks. So it's mainly focusing on the development of the rural areas. So option B is the correct answer. Next one, when was Reserve Bank of India established? Option A 1920, option B 1925, option C 1935, option D 1948. RBI, Reserve Bank of India. It was set up in 1935 under the RBI Act. RBI is the regulator of the entire banking in India. Credit control is an important tool used by RBI as a part of its monetary policy to control the demand and supply of money in economy. Next question is also related to this topic, credit control. So methods and instruments of credit control can be divided into quantitative or general method, qualitative or selective method. Quantitative methods include bank rate, open market operations, variable cash reserve ratio, statutory liquidity ratio. Then quantitative or selective method, it include rationing of credit, margin requirement and regulation of consumer credit, and control through directives and publicity, moral suasion and direct action. So RBI was set up in 1935. So option C is the correct answer, 1935. Then moving on, next question. Quantitative credit control do not include, option A bank rate, option B RBI directives, option C cash reserve ratio, option D open market operations. Quantitative credit control include bank rate, cash reserve ratio, open market operations. So B is the correct answer. B, RBI directives is not the method of quantitative credit control. RBI directives is a qualitative credit control. So here answer option B is the correct answer. Next question, Treasury Bill means option A bill drawn on a treasury. Option B, an instrument is used by the central government for short-term borrowing. Option C, a bill drawn by any authority in sitting in treasury office. Option D, a bill drawn by member of parliament. Treasury bill are instruments for short-term borrowing by the central government. They have maturities of less than 1 year and are part of money market in India.
Treasury bill are zero coupon securities and pay no interest. Okay, they are issued at a discount and redeemed at the face value at maturity. So, what do you mean by zero coupon bonds? For example, I want to take rupees 100 from a person, but I don't want to paying interest. But I am tell him after 1 year I will give you 100 rupees. So why will someone invest or why will someone give rupees 100? So I will tell him today you give only 90 rupees. Okay, I will pay you 100 rupees after 1 year. Other words, I am discounting the face value of 100 rupees. Okay, I am just take 90 rupees and I am promising that after 1 year I will give him 100 rupees. This is how Treasury Bill work. Then Government of India issued three forms of Treasury Bill. 91 days Treasury Bill, 182 days Treasury Bill, then 364 days Treasury Bill. Here option B is the correct answer. Treasury Bill means an instrument is used by the central government for short-term borrowing. That means the period does not exceed 1 year. Okay, so option B is the correct answer. Thank you.